Joining us now, Greg Davis. He's Chief Investment Officer at Vanguard. He oversees $4 trillion worth of assets, circa $4 trillion. I guess that number moves quite a lot on a daily basis. Good morning, Greg.
Good morning. Great to be with you.
Nice to see you too. What did your own pal mean when he said for now, do you think?
I think, when we think about what's happening with monetary policy in the U.S., we've been seeing this just gradual continuation of economic growth in the U.S., tightening of the labor market, inflation expectations continuing to rise. And we think the Fed is continuing on their path of raising interest rates. We expect 2 more rate hikes this year and potentially 2 to 3 next year.
Is that, Greg, dissuading investors from buying U.S. equities? I mean, earnings have been very good in the U.S. Earnings growth has been decent, and estimates continue to come up, which is, the opposite of what we've seen happen the past few years. Regardless, the S&P 500 hasn't really gone anywhere. So what's holding investors back?
I think we think there's a couple of things that are holding investors back, and that would be a combination of, talks about trade tariffs picking up, concerns about what that's going to do in terms of economic growth globally. You also have the fact that the Fed's on this continuous course, and the question becomes, at what point do they become restrictive? And clearly, once they reach that restrictive point where it's too much for the economy, you're going to start to see a slowdown in economic growth, and I think the market is starting to anticipate some of those factors.
What about the dollar? Does the dollar continue to be bid in this environment?
When you think about what's happening with the U.S. relative to the other major central banks around the world, clearly the U.S. is well ahead of the other major central banks. So we'd expect the dollar to continue to strengthen in this type of environment because we think that the U.S. again is somewhere between 12 to 24 months ahead of many of the other central banks when it comes to tightening.
That's interesting because if I look at my WEI screen, I can see we just showed the S&P 500 up, I think, 4.2%. But for European investors, it's obviously a bigger gain, closer to 8.5% because of the strength of the dollar. Do you see European investors continuing to buy into U.S. stocks as a result?
We do believe there'll be continued buying because, again, the economy in the U.S. looks quite robust. And when you think about what's happening, we do think earnings growth in the U.S. has been unbelievably strong, and that's really propelling what we've been seeing in the equity markets. Now, the one caveat to all this, I would say, is that when you look at valuations, U.S. equity market valuations have been stretched, and they've been stretched for quite some time. So when we're counseling investors in the U.S., we've been encouraging them to start looking outside of the U.S. when it comes to investing in equities because valuations look more attractive outside of the U.S. than they do in the U.S.
Is there any concern, Greg, that President Donald Trump discourages international investors from investing in the U.S. economy? I mean, clearly the tax reform bill was good for earnings, but there have been many things, including the separation of children from their parents, the sort of acknowledgement of white power marchers in Charlotte, and now you've got this recent sort of buddy-up press conference with Putin that have angered foreigners about the president?
I think those factors, clearly can have a negative impact in terms of how, international investors, view the U.S. But at the end of the day, I think it really boils down to economic fundamentals and whether or not earnings growth are going to continue to be strong in the U.S. And, for the foreseeable future, we expect that to be the case. Now, clearly, the posturing that you see when it comes to trade talks and some of these other political factors, a lot of it is, again, just talk. You're not quite sure exactly how it's going to play out over the long term. And so we would encourage investors to stay diversified, focus on controlling costs, and ultimately making sure that they, are understanding the amount of risk that they have in their portfolios.
Let's get back and talk a little bit about the Fed for a moment. When does the Fed bite when it comes to U.S. equities? There's a lot of talk about a flat curve and kind of when the curve inverts and the gap between that and when you start to see maybe a recession and stocks rolling over. I got this chart here as well, which is U.S. financial conditions going higher, S&P going higher. That correlation is pretty stunning to me. When does so as long as financial conditions are kind of looking pretty good, right, the S&P continues to rise, right?
That's correct. That's correct. I think that what you have to really look out for is at what point does the Fed ultimately become restrictive? Yeah. And so you think about what is the neutral rate when it comes to Fed policy, and we're expecting that, hey, if you think the neutral rate somewhere between, on a real basis, 0.5% to 0.75%, they're very likely not to reach that until third quarter, fourth quarter of 2019.
Yep.
So at that point, if they go beyond that level, that's when you start thinking about policies being real restrictive.
That's when I sell stocks, right?
That's when the market could start to wobble to the extent that the economy starts to slow down. And at that point, we'd start thinking that whether or not it's emerging markets, whether or not it's equities, whether or not it's credit-related spread sectors when it comes to the bond market, could ultimately start to have some pressure.
If I look at the breakdown, Greg, as far as U.S. stocks year to date, I pull up the GRR screen for the SPX. I see that tech stocks are up 16%, telecoms are down 10%, consumer staples have gotten hit, consumer discretionary is doing very well. How do you see this breakdown continuing? For example, can these big tech stocks continue to run?
You know, the market's really been driven. If you look at it more from a factor basis, momentum has been the big driver. And, you know, momentum stocks have continued to do well, up almost 10%, year to date. And when you think about, some of the other sectors of the market, small caps have done really well because they're most likely to have less of an impact when it comes to trade concerns. So we think momentum and, small cap stocks continue to weather the storm in the short run. But again, for long-term investors, we'd say you should really start thinking about how much exposure do you have to the U.S. market, because valuations do look a bit elevated relative to long-term norms.
Which other factors are delivering returns at the moment? What is working right now? Is it liquidity? Kind of just give me a sense of, you slice and dice the market that way, because a lot of people do with your funds.
Right. Momentum and small cap have been the two big winners so far. Quality's also done quite well, but I'd say again, it's really been momentum that's driving the market as well as the small cap space.
And just before Matt jumps in, how does that kind of the market just seems to get narrower and narrower with everything, and that kind of talks to that sort of trade. Again, back to Matt's kind of point, how sustainable is this sort of increasingly narrow market?
Well, I think what really goes back to is you have to look at the fundamentals, and ultimately when you start looking at valuations, those areas that have done quite well are the areas that ultimately are continuing to become quite stretched when it comes to valuations. And for long-term investors, we'd always say, make sure, number one, that you're diversified, doing it in a low-cost way. But when you're getting segments of the market that have been overvalued or bid up because of just momentum of those things, you have to be cautious. You have to be really cautious.
I just want to ask Greg as well about factor investing, about ETFs that are broken down in that way. I mean, how much is this kind of investing growing for Vanguard, for the industry?
I think it's an area of the market that is definitely starting to take off. We've seen a fair bit of growth in that sector, but it is still relatively new for many market participants. And the reason that it's becoming quite attractive is really the fact that it's a way for investors to get exposure to certain styles of investing in a very low cost way. And so when you think about active management, many active managers ultimately have a tilt to a certain factor. And so by investing in factor ETFs or factor products, there's a way to get that type of exposure in a very low cost way, and that will ultimately start to gain real traction in the marketplace.